I don't think people really understand what they're getting into when they decide that they want to buy a house or they want to be a homeowner, because we make it seem really fun and exciting, but we don't really talk about what's actually going to happen, during the loan process or what we need to expect. I guess the best experience also comes from kind of knowing what's going to happen next or knowing what you're getting into. That way you're going to enjoy the process and enjoy the moment a lot more than just being frustrated about all the things that are coming at you really quick. We're going to spend a little bit of time in this video just kind of talking through all the steps that go along with a home loan approval. And believe it or not, there's probably like 10 steps. They're going to be application, which is when you get your disclosures and you go under contract. Then there's your setup, there's submitted to processing, there's submitted to underwriting, and then the decision part when the underwriter actually decisions the file. Then your file gets resubmitted back to underwriting, gets fully approved, hopefully, and then it goes in the closing department, gets clear to close, and that last one is the fun one, that's funding. So we're going to talk through kind of what each one of those milestones or those particular sections within the loan approval mean, so you can kind of have a better understanding. No jargon, no acronyms, no kind of weird mortgage lingo. We're just going to break it down in kind of real people stuff. So the first one is application. This is when you actually find a property that you want to purchase and you've made an offer and it's accepted, and the lender's going to send you your property specific initial loan disclosures with this house and hopefully the right estimated insurance and the right taxes with any exemptions, getting that interest rate and the fees and the costs, so you have a really good understanding of what the monthly payment's going to be and the out-of-pocket costs. The next one's going to be setup. Once you sign your disclosures and you've started to collect some of the documents as far as like pay stubs and W-2s and your bank statements, they're going to be giving that file to the setup department so they can actually order all the third parties, everything that takes time. So there's probably about 40, 50 different people that touch the file through an approval process. But one of the important ones is getting everything ordered that takes time. So that's going to be getting the appraisal ordered. That's going to be done during setup. Getting any kind of verifications of employment or verifications of assets ordered up front. That's what they do during setup. Getting some of the title information submitted. So anything that's going to take a little bit of time to be requested and come back, that's going to be ordered during your setup process. Once the file gets set up, it's going to be sent to the processor. That's where that person actually starts to review the data. All the pieces to the puzzles, all the information that you've been submitting to your lender, they're going to start to organize it and put it in a way that it starts to tell the story about who you are, where you live, where you work, how much money you make, how much money you have set aside, what your debts look like, what your score is. Starts to build that file, so it starts to tell the narrative about your request to be approved for this home loan. And that's what the processor is doing. They're trying to structure and make sure that this file architecturally looks like it's supposed to look. If you're here for an FHA loan, it's got all the pieces for an FHA loan. If you're here for a VA loan, it's got all the pieces for a VA loan. And that processor is putting it in order. Believe it or not, there's a specific checklist or specific order that documents really need to be in. They're getting it prepped because when they submit it to underwriting, the next milestone, that's when the underwriter is really just reviewing the information. Your underwriter, they're the decision maker for the lender. They're the ones that are actually going to be reviewing and checking off everything to make sure that it's compliant, that it meets the guidelines, and that it satisfies all of the investor overlays or investor approvals, because they're going to write a check. If you're asking for a $300,000 loan, they are writing a $300,000 check for that lender, and they're handing it to the closing agent or the title company to pay that seller. So it's a very important role the underwriter has, but the underwriter's just reviewing all of the stuff, and then they may come back and say, hey, I need this, or explain this, or you're missing this. They're gonna go ahead and decision that file, meaning you're conditionally approved. Hey, your file's good to go, it's approved, but I still need you to go get 4 or 5 things that I need. And it might be some corrections to some documents or some additional clarification or some more information that's needed in order to finish up that loan approval. So once you get the file decisioned, expect your lender to be talking to you to be able to discuss, hey, here's the things that we still need, get these things to me, because you're gonna want to resubmit the file back to underwriting. That resubmittal is when the underwriter reviews the file for the second time, hopefully only 2 times. They're going to review and make sure that everything that's been requested meets the guidelines and approvable, and they're going to sign off on that, and the file is going to be fully approved. So that's a big deal. That is a moment of celebration, but you're not finished yet, right? When the file gets fully approved, your processor gets back and makes sure that the insurance is correct with the right effective date, and all the invoicing for things that may have been paid for in advance, like an appraisal, those are all in the file. If you're going to be using a power of attorney or some other documents, that's all been requested and notarized and approved by the title company and maybe the attorneys. So they're doing some work at full approval. Next is the in closing. When the file goes into closing, that just means that your file's fully approved, you're almost finished, you can sit back and relax, and now the closing department is going to start to review the paperwork, send the instructions to the closing agent, and make sure that that final closing disclosure, that document that you've been looking for, hey, what's my payment? Hey, what's my funds to close? That particular final piece of paperwork is what the closing department's actually working on. When they get that approved, they will issue a clear to close, meaning that you're ready. All you need to do is show up at the title company, sign your paperwork, wire in the required funds that you need based on that final closing disclosure, and you are about to be a homeowner. Once you sign all your disclosures, and it's a lot, you're probably gonna have a sore wrist. Once you sign everything, right, that's gonna be sent back to the lender for them to review, making sure that everything has been signed correctly, that all the documents that are there in order to perfect the lien and meet the agency requirements. They say, hey, everything is good. They give funding authorization to the title company or the closing agent, and that means that you are officially a homeowner. So that is basically what happens really quick, those 10 steps or those 10 milestones that somebody goes through when they are application to funding. You know, another good thing that people always want to know is like, well, how much house can I really afford? So that's really a personal question, I think. You really need to talk about it with all the decision makers in the household and find out what is a comfortable housing obligation for the family unit to live on. You know, generally I would say probably about 30% of your monthly income. So if there's two people on the loan and we each make $5,000 a month, so that's $10,000 a month is the gross household income. I'd say maybe about $3,000 a month should be your max mortgage payment with interest and taxes and insurance and any kind of other obligations, because you're still gonna have electricity, water, internet. Those are all expenses that are related to the house, but people kind of forget about those. They only focus on the payment. And you still want to be able to save for your future, right? Like you don't want to be in a position to where you're house poor, where you have a nice house and you can drive to work, but you can't go anywhere because all your expenses are being eaten up, you know, with this house. So it's really more of a personal, I guess, feeling for what you think your house should be. But the qualification number generally is higher. We normally can qualify people for more than what they want to afford. So it's real important when you're talking to your lender that you're talking about not just the qualification. You know, hey, where is the sales price need to stop before the deal just totally falls apart? You know, that's your qualification number. And sometimes lenders focus in on that and say, hey, you're good to go for $500,000, but they don't talk to the home buyer about what that payment's gonna look like. So when they're looking at homes around $500,000 and they start to talk about the payments, and maybe worst case is they go under contract and they get an application and it says, oh my goodness, my mortgage payment's $4,500. That's a pretty big sticker shock to people. So it's really important that you're talking about affordability, which is the monthly payment that you want your house to be at, and then the qualifications. So you know, hey, if I found the house that checks all the boxes, you know, that has the pool or is in the corner cove or it's over here in this part of town, that you have that ability to go up a little bit in your purchasing power to go get that house. Just be mindful that that payment's probably going to go along with it. Here's a good one for you. This is really important when you're talking about preparation. People throw around the terms pre-qualification, pre-approval, you know, and unfortunately, I don't think that social media or a lot of real estate agents or even a lot of lenders really pay attention to what those words mean. Words have meaning, right? And so when somebody says you are pre-qualified, that means that they have typically verbal information, right? They've got verbal income based on what you said that you make as an employee or you're self-employed, and verbal assets, like verbal money that you have in the bank. They might be looking at a credit report that they pulled for you, you know, so it's got your scores and it's got your debts, but it doesn't have anything verified or validated yet. So it's just more of a skeleton conversation when you're talking to somebody. That's a pre-qualification. It's not really worth very much. The other one is the pre-approval. This is the one that actually is powerful, but I think people call it something when it's really not. A real true pre-approval means that a decision maker has reviewed and approved the file. That is not a loan officer. A loan officer cannot decision a file because they're a production-based person. Me, the comp factor, 25 years of experience, super knowledgeable, do not carry the right credentials to actually pre-approve somebody, right? I am not a decision maker for the company. That is an underwriter who carries the right credentials to be able to make decisions for the lender. That's a pre-approval, right? But a lot of lenders will throw that term around, you're pre-approved, and they don't have the right documentation. A true pre-approval means you submitted your income, pay stubs, W-2s, tax returns, maybe retirement letters, maybe some social security letters, your assets. I'm looking for your bank statements. I'm looking for your retirement accounts. Now it can be electronically verified. So we can do a verification of income electronically. We can do a verification of assets electronically. But this is where you actually review and approve the income and the assets. We've got your credit, we've got your debts. We've already electronically approved your file through an electronic system, maybe through desktop underwriter or loan prospector, but that file gets pushed to an underwriter and they review it and they agree that this file meets the eligibility guidelines. That's a real pre-approval, right? So it's expensive. Lenders don't want to work on files that they don't have contracts for. So just be mindful, pre-approval is powerful. And it means something, and you should look for that to make sure that you're good to go. Pre-qualification, just more of a conversation, and it's not really worth that much. A couple more here real quick. The truth about down payments. You don't need a big down payment to purchase a house. A lot of people still think you need 10%, 20%. That's not the truth. A lot of people think you need a big down payment to make your mortgage payment smaller. That's not the truth. The truth is you can get into a home for 3.5%, maybe 3%, maybe no money down with the down payment assistance. And the fact that you're not making a big down payment is not going to move your mortgage payment very much. The truth is it's normally about $6, maybe $7 for every $1,000 that we don't borrow. So if I had $10,000 to put down extra on a house, that would save me maybe $70 a month. That's not going to be enough to get me excited in a monthly payment. So you would be better off hanging on to that money, leaving it in the bank, or maybe paying off a debt that had a larger monthly payment obligation than that $70 a month. And the last thing I'd like to share about trying to be ready for a home buyer is be ready. When you go under contract, it's going to feel like you're on a rocket ship. The amount of activity and the amount of requests and attention on you when you go under contract, it's a lot to take in, especially if nobody told you what was going to happen. So when you go under contract, you can expect to be writing checks for your earnest money, typically 1% of the sales price, probably some option money, maybe a couple $100. You're probably going to spend some money on a home inspection for sure if you're going to be living in this as your primary residence. Once you go choose your lender, you're going to be paying for an appraisal, most likely. That's going to cost you another $700 or so. So you're going to be writing checks right at the beginning. That's going to be stressful, right? That you're spending all this money, you don't even have a house yet. And then you're going to be requested to sign disclosures. They're all time sensitive. You're going to be requested to click this link to verify your income, click this link to verify your assets. There's going to be a lot of activity right at the beginning when you go under contract. It's going to be worth it. But just like anything, the most energy is right at the beginning. So you're just going to be thrusting everything. And then once you get your loan in the air, it should be smooth sailing all the way to the day that you become a homeowner. So if you like stuff like this, if you want to learn more stuff like this, be sure and like, subscribe, and tune in next time for more stuff from the Comp Factor.